Hey everyone, welcome to today's session. Happy Tuesday. Let's jump right in here. Market conditions, bullish in a bull market, still at the upper end of this range. This is definitely getting more extended by the day. Let's break this down. I'm going to start down here at the bottom, and let's start out with momentum. We're at the upper end of this momentum range. This actually is becoming kind of rare for it to be this high. I've seen it this high before, but it's not very common. So once we reach this range, several things can happen. Obviously, we are going to start to either maintain this and hold this for a few days. It doesn't last too long, or we start to move back this direction. Now, we've got all the way back to here for it to still be considered a bullish uptrend. So we can move all the way back from here. We can dance back and forth inside of this. All of this is still uptrend. Okay, once we get back down into this range, then it is a warning, kind of a warning flag to say, is this where we're ultimately going to be trending, or is it going to pause, find some support and move back up again, or do we start to fall back into this bearish trend? Okay, so you can see where we're at in relation to where essentially the real risk really becomes of the trend becoming a downtrend. We're at the upper end of that range, and we know that this is just not sustainable. This doesn't last forever. This is an area where we start to feel like it's always going to be like this, and then within a day or two or three it snaps back and we get pulled back into reality. That being said, we want to continue to trust the direction as long as we possibly can. What we want to use these indicators for is we want to use them for allocation. We want to use them for helping determine how much exposure do we have to equities, how much exposure do we have to cash, how much exposure to bonds, to commodities, all those different things. So we're going to spend a little bit of time kind of reframing that mindset of what do we want? What are we doing in terms of equities, stocks? Or how are we utilizing these? Are we utilizing them to gamble? Or are we utilizing them to create a structured growth strategy where we know that equities can outperform over time? Are we trading the right ones? Are we trading at all? Are we trading hodgepodge of just picking and choosing different ideas and hoping they work? Or do we have some kind of a structured plan to that? So we'll break that down a little bit today. Also, breadth has moved. It really hasn't moved much. It's been quite good in relation to where it's been. We have pulled back out of that extreme zone and starting to work its way back a little bit here, and then sentiment in that upper range. Complacency versus fear. When we have this, I prefer the term complacency versus greed. Same idea though, is that everything is good. We're markets are going up, we're making money. That we want more of that, which sometimes creates complacency. It's like, oh, this is going to last forever. Oh, hey, I've been doing well, let me double down, or let me add more assets to this trend. We become complacent when things get to the upper range, and this is the exact wrong time to become complacent. Okay, it's the exact wrong time to double down and go aggressively into the market. What we would want is, either a pullback or somewhere along the range or an uptrend. We can certainly still be adding into equities because this is the market as a whole. And part of the strategy that I utilize in the new buy daily strategy is adding into a stock each day, because it allows us to always be engaged in the market. We may not be 100% engaged. We may not have all of the assets, but we may have something that's always working. And that'll typically happen when we start to see muscle stocks that start to show up different kind of ideas. Maybe we start to see more oil stocks coming in here. Maybe we start to see more commodity type stocks, or whatever the case may be. This new buy list is always going to be working with stocks that are in uptrends and they're having new buy signals. Doesn't mean that they can't reverse, but what it means is that for whatever reason, these stocks are still working, and we want to continue to move that direction and participate in those kind of stocks. Let's go back. Let's finish up here on market, because we did have the we had the buy-sell ratio flip back up to 1.25. It was 1.03 yesterday. So we're moving in the right direction. And this is not abnormal to see, a little bit of choppiness after a pretty nice uptrend, and particularly where we're at the upper range of the momentum cycle. We're at the top end of that, and to see buy-sell ratio just kind of flat right here, that's not surprising. One of the other things that I did notice this morning is on these on the indices, on the index scans, we still have some pretty decent buy-sell ratios for the indices. So NASDAQ 100, and really these are the indices that have been leading the market higher. S&P 500, a 2-to-1 reward to risk. So these indices are actually quite a bit better than the broad market buy-sell ratio, which is the broad market. So this is analyzing all the stocks in the database, and versus these indices are just focused on certain stocks that have been put into these indices, and they're doing quite well. So we obviously know what's leading the market, and it's going to be these stocks. So until that stops, and until we see this even start to move back down into a 1, or anything less than 2, anything less than 4, like the tech is still continuing to work. There's a handful of stocks that are continuing to work, and that is moving the market higher, and that's okay. It's just going to probably be less and less and less. Let's take a look at this top 100 and see what they are. So NVIDIA, that's obviously been the top end of the range, had a nice breakout, continuing that overall move higher. It's well into the momentum zone, reaching the highest point it's reached in this last 6-month time frame, and probably all time, the 1-year time frame here as well. So we're seeing really nice move in NVIDIA. That's been leading the market, and really anything to do with that. Broadcom, which is also going to be in that semiconductor chip world. We're seeing Adobe, Netflix, Amazon, Lam, Microsoft, Google, Intuit. This is the who's who of world market leaders at this point. Costco, Micron, and these are great companies. These are great stocks. They've been doing well. They've been moving in overall uptrends for the length of this market. So we're seeing pockets of strength. But if the pockets of strength start to weaken, then a lot of the other market participants have also weakened, and that could give us a retracement. Again, nothing to be overly fearful of, other than what I would be watching for is I would watch, where am I here? There I am. Okay, this one right here, S&P 500. So S&P 500, this upper range, okay, we're towards the upper end of the range on momentum. We've got now all the way back to that 455, 465, or 465 range, and then also this 475 range for some support on S&P 500. So any pullback. So we're still in a buy the dip mentality. We could pull back to here and still be buying the dips. We could pull back to here and still be buying the dips. But as of this point right here, depending on how your trading plan is structured and how you're harvesting some of these gains, it's a good time to rebalance. Okay, so rebalance is essentially, and I talk about this every week because it's important, and that is if your portfolio is 50-50 and you're 50% cash or bonds and 50% stocks, but now because your stock portion has increased, maybe you now have 60% in equity exposure because it's just increased in value. If that's the case and you want to rebalance it back to a 50% holding, then you've got to sell a portion of the gains to get you back to this balanced portfolio. So that could be sell a portion of all of your winners, okay, or sell a portion of everything in there just to rebalance back into this additional holding. That, depending on your approach, you could rebalance this once a year. You could rebalance it once every 6 months, rebalance it every quarter. You could even rebalance it every day. That's probably more management than necessary, but it's entirely possible to be able to make those kind of adjustments. Okay, so S&P 500, again, right now, it's just about, are you positioned in a way that you would be comfortable with a downturn? If you're not, then what does that look like for you? What does it look like for you to be positioned in a location that you could ride out a downturn? Now, depends on who you talk to, but You may say, oh, you always need to be in the market because anytime it pulls back, you never know when it's going to bounce. You never know how much, how fast it's going to go up or down. And I do agree with that to some extent, in terms of we never do quite know which day or 2 or 3 is going to be the most powerful trends within that uptrend. So we always want to have something invested if our approach is a bullish strategy. And 95% of our approaches within TradersPro are bullish long only strategies, minus, even with the ETFs. If we have an inverse bearish ETF, we're still long that direction. I don't see anything that's bearish right here yet, because we really haven't seen anything. But the overall methodology is we still want to be long. We're not going to be short. We're not going to be in and out in bullish and bearish directions a lot. We're just focused on stocks that are going higher. And remember why. The methodology behind this is that a company or a stock, I shouldn't say a stock, but a company is designed to go up forever. It's designed to grow. Okay, it's designed to continually grow. What happens when it doesn't grow is it declines and eventually it goes out of business, right? Companies have to be profitable. They have to grow in order to exist. And in order to do that, then you have a lot of resources that are allocated towards companies growing. Brilliant marketing minds, brilliant product designers, brilliant product creators, all kinds of cool things going into new ideas and into new areas. And all of those new ideas and all of those resources are going into every sector. They're going into builders. Okay, this is a building product, Woodstock. Okay, they're going into pharmaceuticals. You're seeing lots of momentum here in the drug and pharmaceutical world. You're seeing it go into data. Datadog has had a really big run here as well. It's just going into everything. All of these really cool ideas and growth ideas, we want to be able to participate in those ideas. And about the only way to do that for most of us is to buy the stock, is to anticipate that the growth of all of these new cool innovations and new cool growth ideas are going to increase the value of that enterprise, increase the value of the stock, or increase the value of the company, therefore increasing the value of the stock. Just remember what the stock price is. The stock price is the current value or the present value of the future earnings of the company. Okay, it's a net present value in its real-time valuation. It's real-time price discovery. It is everybody out there deciding what the value of this stock is worth as of right now. Okay, as of right now, VKTX, this medical biotech stock, the market agrees that $23.89 is the market value for this stock. That is currently, based on all things known and all things anticipated, the current value of the stock, because that's what the market says it is. And the market is always right. Okay, the market is always right. Where the market can be wrong is in their anticipation or their ability to know all of the information. There is information that isn't known, and that's called inside information or insider information. That information is not known to the public. That's not known to us. So until that is known, and if it's bad information, we don't know that. The market doesn't know that yet. Once it is made known, say, for example, an earnings report, it comes out and it's like, holy cow, that thing did way better than the market even expected. Well, what happens the next day? The stock gaps way higher. Why did it gap higher? Because that information was unknown. The second it became known and it was better than the market had anticipated, the price goes higher. If it was worse than anticipated, it goes lower. So that decision-making process is happening every second of every day, as long as the markets are open. So what we want to focus on is we want to focus on which ones are moving that direction, because they're moving that direction for a reason. They're moving that direction because they've got some innovation, some product, some idea that is, benefiting humanity, and humans are buying the product. They like it. It's working. It's growing. I want to be a part of that. I want to grow my capital amount by using this as the vehicle to do so. Okay, now another hard thing, which one is going to be the big one that's going to win? I don't know. No, neither is anybody else. So what we focus on is we focus on strength, what is currently a strong stock, in terms of the market believing it's strong, therefore bidding it higher, therefore moving the price trend this direction. Okay, that is our path of least resistance, a stock that is moving this direction. Why is that the path of least resistance? Because that's the current trend. That's the river. The river is flowing this direction. And if we want to expect it to go this direction, or expect it to go this direction, or this direction, or this direction, or this, okay, we're fighting. So let's just stop fighting the trend and continue to go with the trend. As it's continuing to go higher, that's what we want to focus on. And we're going to be right more times than not. And we're going to have a few of those trades that ultimately do amazing and really take off. Okay. It's kind of, again, this wheel idea of we're working on this wheel, and we get, maybe there's a stock that comes out like this and it's profitable, and we get another one and it comes out like this and it's profitable as we're building this wheel. And then we get one of these stocks that is not profitable. We get another one that's kind of profitable. And then we get one that's really profitable. And we get another one that's decent. Okay, we're just continually growing this wheel. And every once in a while, we get one outlier that really does well. Those are the ones that ultimately are going to give us a big boost in the portfolio. And we're going to have a lot that are just average. We're going to have a few that are losers. But over time, we're still working our way this direction. We're working our way this direction by buying into a new stock today and another stock the next day or each week. Okay, whatever that time frame is that you're comfortable with, is continually to have a process of buying into these kind of names and these kind of stocks over time. So most of the time, the market direction doesn't necessarily hinder. It definitely helps. And when we're in a downtrend, what happens is the market throws out the baby with the bathwater. Okay? And so some stocks that otherwise do well oftentimes don't. So we can still do well in a downtrend, but it's ultimately, as stocks are continuing higher, we're stock picking is mostly what we're doing, versus trying to anticipate what the economy is going to do, what sectors are going to do, what the market is going to do. We're focused on these individual stocks, those individual companies each and every day. Which ones do we want to be a part of, and which ones are continuing to work? And we want to do that in a portfolio methodology that allows us to reduce our risk as much as possible. So we do that with a lot of stocks, and that allows us to diversify. Yet in this, we've come up with almost all of these stocks, minus maybe the top 3 or 4, have all been new stocks that we've added in the last 30 days. Okay, so some of these are continuing to work. We've been stopped out of some have really done well. Some will continue to do well over the next month or two. Some will continue to have these trends that just keep going and going and going. This is where we start to say, I don't know how high it'll go, but then, and so we utilize a stop loss. We continue to let it work and continue to move higher, and we have a stop loss in place, or we start to sell into the strength. Okay, so this position I've actually sold down now. So we have a little bit less. I don't know if I'm going to be able to find it in here, but we've got, let's see if, there it is right there. So 2.25% is our allocation now. Okay, so 2 points, maybe hard to see, but it says 2.25 right under that 2874 number. Okay, but it's gone up by 132%. So that should be more than that, right? Well, it's because I've trimmed it back. So now I have, instead of 300 shares, 150 shares, and that now has put me back into balance with this holding. Okay, and now I'm just going to let it keep going. If it keeps going higher, great. Eventually we'll trim some of that, but we also have a stop loss on the remaining shares. So the ones that just keep going, let's keep going. Let's let them keep going. We're going to harvest some of the gains along the way, and we're going to have some losers along the way, but we're just continually focusing on adding into those new ideas. And some are going to pop like this. We've seen it now. Those of you that have been joining with me now for the last 8 months or so, you've seen this. We saw a nice move in a lot of the Bitcoin mining stocks. Now we're seeing in the biotech world, medical world has done real well. In the next few months, who knows which trend and sector is going to start to rise to the top, but we will be a part of that. Okay, and so it's a it's a systematic, relatively easy model to be able to utilize, and it's profitable. We're up 27% in this time frame from September 1st. On this portfolio, S&P 500 is up about 8% in comparison. So we've had most of it in cash, and we've been really well diversified across a lot of different names, and we've outperformed the S&P by 20%. And that's really what the model is designed to do, is to allocate across a group instead of just trying to pick the right one. That's really tough to do. Let's let the market play a part of that as well, in terms of which ones are working. The market has told us now by the performance that this stock is doing something right, and the market believes in it, and it's continuing to move this direction. Then you get some support, a retracement that pulls back. Now you've got a support here, a new buy confirmation, back up again, and away you go. Start that process all over again, and making sure that the risk is small, because the markets can turn, stocks can turn, earnings reports can come out, bad news can come out. We want to be able to make sure that we've protected ourselves against any kind of real blow up of one stock. If one stock blows up, it shouldn't affect us at all. It might affect us by maybe a few percentage points here, but it really shouldn't affect us. And that's ultimately what I want to be able to provide going forward long term, is a methodology for you to be able to continually grow and protect your wealth using stocks. And this is one of the ways to be able to do that. So let's see, let's jump into, we spend time on market conditions, again, just because there are themes that start to happen, and there are themes that you're hearing and you want to be informed on as well. And one of those is interest rates. Interest rates, we know that we had this big run up in bonds, which means interest rates have been dropping, but now the bonds have been dropping, which means interest rates have been rising. So now we're seeing bonds start to curl back up. So do we have some support and bonds start to go back up, which means interest rates are going down? I don't know, but that's what's starting to happen. Will the market want that to happen in order to continue to rally? Probably so. We're going to want to see interest rates flattening to coming down. The market is expecting interest rates to come down this year, because the Fed has forecasted that, and that's part of the reason why we've had this big rally. So we want to be aware of what bonds are doing. And in this case, it's really nothing super negative. It's actually kind of positive. Nice run up, supported at 382 level, finding some bounce. If we can bounce back up above that 96 and get up above the momentum range, then the market may also want to be rewarded for interest rates anticipated moving lower. The other one we want to look at is oil. Let's come to sectors and come here to oil and commodities. That's where I wanted to go. If we look at commodities and oil, we've seen oil now having this big push, and the 1 year time frame, it really did chop around here for quite a while, creating some a real solid base, a real solid foundation. Now we've broke out above that. Okay, so this is a trend reversal, or the early stages of a trend reversal in oil. And it could reverse and head back down this direction, but as of right now, it's back up above this support. This now is our trend direction. This is our next area of support. And we want to be able to focus on that as well, and at least understand what's happening with several of those different commodities. The other one that we like to go over is gold, and gold is having a bit of a move today here. Let me just, so we found some support here. If gold holds this range, this actually could be constructively bullish for gold also, and that might be an interesting trade if it holds up right here. I think long-term gold has got a place in a lot of portfolios, but because it ends up getting talked about a lot, I thought we can at least cover it, because sometimes we do, when you see gold rally in the new buy list, you may start to see gold stocks come in, and they're not super efficient. The companies are never that great. It's just that the price of their commodity that they mine has become more valuable, so they can sell it for more, and ideally that drops into their profitability. Let's see. Let's jump over to muscle ETFs and just kind of get a quick idea. See if there's, sometimes we can glance at these and see what else is working. Natural gas, we'll jump back into a different chart here. Qs, the triple Qs, there's a 3X ETF. Okay, this is towards the upper end of that range. We've seen a nice run up. Triple Qs or TQs is 3X the NASDAQ 100. So it's going to be pretty volatile. If NASDAQ 100 goes up 1%, this is going to go up by 3%. The inverse is true. NASDAQ 100 drops by 1%. This drops by 3%. It's in lockstep with that direction. Sometimes there's some inverse ones in here as well, but we haven't seen any real reversals yet. And so we're at kind of an interesting phase right here where we haven't seen any real selling or any real reversals. We're still seeing buy dipping, we're still seeing dip buying, excuse me, but we're also really extreme in this upper range. We've got a buy sell ratio that's not real solid, but there's room for expansion on the buy sell ratio. We may see some of those small and mid cap stocks get bought up again if the markets can really hold. Maybe we see earnings that really come in really nicely over the next 6 weeks or so and push the market higher. Nonetheless, that's all conjecture and that's all opinion, which I don't want to rely on. I want to rely on the data primarily. And in this case, momentum is extreme, breadth is positive, sentiment is extreme, and sentiment here is also extreme. Bond yield curve is still ugly, and so there are some things that are out there kind of hovering that potentially could be issues. But remember what the stock market does. The stock market is looking past everything that we think is relevant. It's already looking way past that. So the fact that the market is where it is, yes, we can make some decisions, but overall the market is looking forward and it's just not seeing any real big risk factors, at least as of yet. So let me just recap here. Also, keep your eye on that new buy list, stocks that are added in here. You can also create and screen out and fine tune that process. For example, on the new buy list, maybe you want to add stocks that have a little bit more volume because that is a large list. Okay, it's a lot of stocks now. Last week there was hardly any, but now we're seeing a lot more stocks coming back into the market and some good looking names here up above 90. And so we're seeing that. But if we wanted to make it a smaller number, then I could take essentially that new buy screen, which is here, and I could add another variable to that. In this case, I'm adding 50% increase on volume. And when I get that, I get 23 instead of 90 or whatever it was. And it's giving me just the top stocks that also have a new buy signal, but then also have a big volume spike with that. Okay, let me get back to here. You can see that volume spike yesterday was significant over and above the volume bar before. So I can add additional criteria into my scans if I want to. If I want this number to be smaller, then I'm only looking for certain stocks with certain criteria. If I were to add, okay, I want new buys, but I also want PE ratio has to be better than 1, and I want a dividend of at least 1. Okay, if I add that into my criteria, those numbers start to get smaller. But now I know, hey, here's a stock that had big volume, big gap as well, really good numbers. It's got a dividend. It's like, okay, I've got additional criteria. That's going to be the list of stocks that I focus on versus just a raw new buy scan. Okay. Easy process to optimize, easy process to be able to add additional criteria so that you can refine. Again, it's just to filter out any other criteria that you may not want if the numbers are too big. I'm going to end on that note. I appreciate everyone's time and effort today and have a fantastic day today. Bye now.